Are we broadcasting? We're here. Hello, everyone. We're just going to give everyone a minute or two to arrive, and then we'll begin. Hello, everyone. Welcome to our webinar today, all about understanding the Main Street Lending Program in the spirit of funding forward. We're going to ask that you please post your questions in the Q&A only. The moderator will be tough for her to move between the chat and the Q&A, so please post in the Q&A only. We will be posting a recording of this webinar and slides shortly on our community site at realtime.inc.com, and later in the day we will also be emailing a copy to participants. A little bit about myself. I am the founder and CEO of MultiFunding. I am Inc. columnist writing on business lending issues. I have advised the White House, Federal Reserve, and Treasury market on business credit markets. I have a book out called The Growth Dilemma, and for my EO friends out there, I'm a proud EO board member of EO Philadelphia. My lawyers asked me to read a few disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement the program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. Just some general observations. Most entrepreneurs and business owners I meet today are focused on survival instincts. People are at home and, frankly, afraid. There's a certain herd mentality, certain fear. Well, let's face it, coronavirus and the impact on the economy and the world and the future is quite fearful. But all that being said, crisis always brings opportunities. And for us as entrepreneurs, different doors are going to open, and we have to think about and prepare ourselves for how we're going to take advantage of these opportunities. This is the time to be thinking about what is next and reimagining our businesses. This is the time to be preparing for a battle. Rebuilding our businesses, evolving them, and growing them is going to be a battle in this new world. We need our strategy. Are we going to pivot 5%, 50%, or 90%? It's hard to tell, but we'll need to pivot. Who is our team going to be going forward? What is our team going to look like, and how are we going to motivate them? And to prepare for this battle, we need ammunition. In any war or battle, you need ammunition, both offensively and defensively. And going into a battle like this, ammunition is cash. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario? Where will the cash come from, and how much are you going to personally risk? That's what I want to talk today about in the Main Street Lending Program that will go live at the end of this month and will last through September 30th, 2020. So there's a fairly short window to take advantage of it. It is comprised of 3 facilities: a new, a priority, and an expanded. You will go to get one of these loans to your bank, to your savings association, or your credit union. Unlike PPP, where thousands of lenders across the country participated, we think that there will only be a few hundred lenders doing this program. In order to be eligible, you have to be established prior to March 13, 2020. You have to have, if you have more than 15,000 employees or $5 billion of 2019 annual revenue, you're disqualified. And you have to be created or organized in the United States or under the laws of the United States with significant operations and a majority of your employees based in the United States. You need to be a partnership, an LLC, a corporation, an association, trust, a cooperative, a joint venture with no more than 49% participation by foreign business entities, or a tribal business concern. If you are in the developer or a landlord, you're ineligible, and there are certain specific other industries such as lending industries that are also ineligible. Sorry, guys, hit the wrong button. Affiliation rules apply. So for companies that you control more than 50% of, they are going to look at the combined debt, leverage, EBITDA, employee count, and revenue to factor in consideration. The two primary facilities that apply to most people are the new and the priority. Facility means a fund or a mechanism or a type of loan created by the Federal Reserve Bank. The new and priority share many commonalities. They are secured or unsecured, depending on what you negotiate with the bank. They have a 4-year maturity. Principal and interest payments are deferred for 1 year, and unpaid interest will be capitalized. They are priced at an adjustable rate of LIBOR on the 1 or 3 month index plus 3%. The minimum loan size is $500,000 and the maximum loan size is $25 million. Prepayment is permitted without penalty and fees to enter are 1 to 2%. Let's talk about the new facility. The big difference between the new and the priority is the rights that your existing lenders have, if you have them. For the new, the existing lenders have to agree that in case of bankruptcy, the new lender will have the same rights as they do, but the rights of the other lenders in the normal world doesn't matter. On the new, you pay no payments for year 1, although interest accrues. In year 2, you pay interest only, and then the end of the year 2, you pay a third, and then you follow the same pattern for year 3 and year 4. Let's take a new loan facility where you, as an example, where you can borrow up to 4 times your EBITDA. So to take row number 3, a company with $2 million of $500,000 of EBITDA, the maximum they could borrow would be $2 million. However, if they have $1.5 million worth of existing debt, their potential new money is $500,000. If you take row number 1 in that example, that company had $500,000 of existing debt, they could borrow $1.5 million. A new loan scenario is a company with $125,000 of 2019 EBITDA and no debt could borrow the minimum of $500,000. Now let's talk about the priority facilities between $500,000 and $25 million. What's different between these and the new is that in these cases, the lenders have to have senior or equivalent rights to your current lenders. And they amortize a little bit differently. Instead of a third at the end of year 2, year 3, and year 4, it is 15%, 15%, and 70%. So to take a priority loan facility in row number 3 with 2019 EBITDA of $500,000, their not to exceed would be 6 times that, or $3 million. If that company had $1.5 million worth of existing debt, they could get a priority loan facility of $1.5 million. If you take row number 1, where their existing debt was $500,000, their potential new money on a priority loan facility would be $2.5 million. A priority loan scenario is a company with 2019 $83,000 of 2019 EBITDA and 0 debt could borrow $500,000. Now let's talk just for a minute about an expanded facility. To keep in mind, to get one of these, you have to have a minimum of $28.5 million worth of existing debt. So if that's not you, save a few brain cells and turn off for 60 seconds. These operate in a similar way, but they operate as an extension of your existing debt with your existing lender, and the lender can create a facility of up to 35% of your existing debt. So to take an example, in row number 4, a company of 2019 EBITDA of $10 million and existing debt of $100 million could borrow 35% of that, or $35 million, under an expanded loan facility. What are certification and covenants for lenders under this program? You commit to refrain from repaying the principal balance down of any loan that you already have. You commit not to reduce or lower your current lines of credit with this facility, and you commit to agree and certify that you have reasonable basis to believe that your company is not going to go bankrupt in the next 90 days. You commit that you will follow certain compensation, stock repurchase, and capital distribution restrictions. There are changes to that, or exceptions to this if you're an S corporation or another tax pass-through entity. You agree while you have the loan and for up to 12 months after the loan is paid in full, not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earned between $425 million and $3 million in 2019, you agree not to earn more than that while you have the loan and one for 1 year thereafter. If you earned in excess of $3 million, say $6 million, what you do is you take the 50% of the difference, say between 3 and 6 is $1.5 million. And in that case, you agree not to earn more than $4.5 million. You agree to make reasonable efforts to retain your employees for the duration of the loan. However, let's be clear that the standards are much less stringent than the PPP. The goal of this loan is to help build and save companies, not to save jobs. Your bank will calculate your EBITDA in the same way your bank has historically calculated EBITDA if they've worked with you before, and if they've not, they will have to calculate your EBITDA like they've calculated it for other companies like yours. Your debt will have to determine your existing debt. They will look at all your loan facilities, including unsecured or secured loans from any bank, non-bank financial institution or private lender, as well as any publicly issued bonds or private placement facilities. If you have an asset-based line secured by your AR and inventory, they will calculate how much you can borrow or you have borrowed against it. They will not factor into consideration how much you could borrow. So to take a comparison, in row number 2, a company with $4 million of EBITDA and $10 million worth of existing debt, they could get a new loan facility of $6 million or a priority loan of $14 million. And depending what their needs are and what they could negotiate with their existing lenders, they would depend what they wanted to do. Just to think about this holistically, financing strategy is both offense and defense. Let's take 3 examples of companies and how they're thinking about this. One is a company with a $3 million line of credit and $1 million drawn. The line of credit has a personal guarantee. They're planning on getting an MSLP for liquidity. They would rather not personal guarantee the capital required to reestablish the business. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. Example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario? Where will the cash come from, and how much are you willing to personally risk? And as you look forward into your company and make your plans and think about your pivots and what the future looks like, what will your cash requirements be, and could Main Street Lending Program and the resources that help you reach your goals? Now we've ended the end of our presentation, and I welcome your questions. I'm going to ask the moderator to start taking them. We will take Main Street Lending Program questions first, and then at the end of it, if there are any PPP or EIDL questions, we'd be happy to take them also. Kate, thank you.
Hi, everyone. We have a question here from Deborah. She says, if EIDL SBA is available, is that a better option than the Main Street Lending Program?
That's not a, right now the EIDLs are capped at $150,000 unless you were approved previously. They're not necessarily mutually exclusive, and it depends how much money you need and how much money you could get from each program.
Russell's asking, what potential impact do you foresee with accepting an EIDL loan for $150K on the hierarchy of the position of the MSLP and EIDL in bankruptcy? Do loans originate in 2020 even be considered for this position?
Well, I think the loans that originate in 2020 will be considered, and I think that I don't think, at least in the guidance we've read so far, that they've thought about EIDL versus MSLP. And if you are able to get an MSLP for much more than the 150, I would advise you to hang tight, and I'm happy to discuss it with you offline, but figure out which way is best for you. But the EIDL could create a complication for you when you're trying to get your MSLP.
This is a two-part question. Can a Main Street lending program loan be used to pay off other high interest debt such as an MCA?
It's interesting because you cannot use it to pay off high interest debt. However, interestingly enough, an MCA is not considered debt, so there might be a workaround around that.
And the second part of that is, will having an MCA with a UCC lien preclude me from getting an MSLP loan?
Well, it wouldn't necessarily preclude you. It would depend what the rights are of that lien and what you might be able to negotiate with them.
Bill's asking, at the end of year 4, will there be a possibility to renegotiate?
It's unlikely that there'll be a possibility to renegotiate, because especially if the economy, as knock on wood it will be doing well back then, you'll really have to work on refinancing it with something else instead of renegotiating. You might be able to refinance it into a different instrument with your bank or another bank.
Tom's asking, is it recommended that anybody interested in the program should discuss forbearance options with their bank as a bridge to the additional credit facilities?
It really depends what your relationship with is, like your bank, and if your bank's going to want to participate in it. I think it's a bigger strategy question that's hard for me to answer without knowing more about your circumstance.
Jim's asking, is positive 2019 EBITDA required to qualify for MSLP?
Absolutely. If you didn't make good money in 2019, you're not going to get the loan, at least the way it's constructed now.
Scott's asking, we have an old SBA disaster loan directly from the SBA. Will the SBA subordinate the loan to the MSLP in the capital structure?
Again, depending on the new or the priority facility, that depends, and it's a super important question. It's tied to the EIDL questions now that we're facing, and I would hope so. I'm not sure if they'll do it only for the new or the priority, but that is something that we're going to have to take a careful look at.
Okay, this is an extended question. So Michael's asking, what are the affiliation rules that will be used for MSLP? And our ownership group also owns a separate LLC with real estate.
Yeah,
The mortgage on the real estate be can. Go ahead, you want to answer the first first?
Our understanding is that if your ownership group also owns the real estate, the mortgage of the real estate will be considered, although it does not have to be considered in the rights, but it will be considered in the debt calculation. So mortgage lenders don't have to subordinate their rights, but to the MSLP lenders, but the amount of mortgage debt is included in your leverage calculations.
Just to note, there's some questions about where they'll see this PowerPoint again. We will be hosting it on the community group, and then we will also send you an email with the presentation and the recording later today. Lee's asking, I opened a new location mid-year last year, so my end of year P&L was in the red. Started profiting in January and have stayed afloat through COVID. Is it worth applying, or will my red bottom line from last year preclude me from getting the loan?
I guess the question back to Lee is how will you do it in 2018? And might the lenders consider the start of the new facility as being a one-time expense and make an exception for it? So some of that will be dependent on how you did in 2018 and how the whole thing looks in general.
Okay, we'll see if Lee reaches back out and follow up on that. Can you give a ballpark of the rates for MSLP?
The rates are about 3.5%.
Lee's follow-up is, she's saying, yes, 2018 was better.
So it would be considered about what your 2019 numbers looked like without that startup cost, and if the bank would consider that as a one-time expense. So the answer is maybe.
Tom's asking, are we getting closer to this program launching in the next few weeks? Is there a list of source documents borrowers can start gathering to proactively and ready to apply when the program starts?
Yeah, so we are expecting it to open up by the end of the month. The chairman of the Federal Reserve committed to that in the Senate Banking Committee this week, which is good news. Banks aren't open yet, although interestingly, we already have some term sheets for our clients from some banks that are planning to participate. And there's not one source document list. We do have one we're using with our clients, but there's not one open source list of documents yet. This will be a much more complicated application process and a much more involved underwriting than the PPP was.
Okay. I think we are caught up on questions.
Right. Well, if anyone wants to reach out offline, if they have any specific questions about their opportunity or want to talk about services MultiFunding is working with borrowers on this program, we're happy to. But we're also happy to continue providing this education, and we'll continue updating the community as the programs evolve and emerge. And Kate, unless there's anything else, we're going to wrap up.
I think we are good.
Awesome. So I wish everyone be well and Godspeed, and have a great Memorial Day weekend. Take care, everybody. Bye-bye.